What's going on? Welcome back to the channel. So elections are right around the corner, and a lot of people want to know how can they benefit from the elections? Which sectors are going to do well, which are going to underperform? And I wanted to play a webinar. It was originally done through Seeking Alpha, and it goes over all quantitative strategies on how to pick the right sectors for through the election season. So I wanted to go over that with you. So if you have any questions, concerns, let me know. It is roughly around 30 something minutes. A lot of good information. So highly suggesting kind of taking some notes. And if you have any questions, let me know in the comments below. With all that, appreciate all of you watching.
Today, I am joined by the one and only Steve Crest, our VP of Quantitative Strategy and Market Data. With over 30 years of experience in equity research, quantitative strategies, and portfolio management, Steve is well positioned to speak on a wide range of investment topics. His contributions form the cornerstone of the Seeking Alpha quant rating system, which is designed to interpret data for investors and offer insight on investment directions. He is also the founder and co-manager of AlphaPiix, a systematic stock recommendation tool designed to help long-term investors create best-in-class portfolios. Today, Steve will demonstrate how to use the quantitative approach to remove emotion from the investment process. And we will explore how the policies of each of the two candidates could shape markets, industries, and investment portfolios. Steve, I am so excited for our chat today.
Lisa, I am so excited to be here, and we are so close to the election, just being days away. So my hope is this presentation today will help individuals be able to decipher, regardless of who wins, Trump or Harris, how to select stocks for their administration. So today's presentation is going to cover the economy and the markets, election data points, and the Trump and Harris agenda. And with those agendas, we will show you how we use our screeners to pick which stocks would be best according to the agendas of those candidates. So, first off, why quant? Well, what we want to do is help you identify strong stocks, being our best strong buy recommendations using data driven methods. So, what is quant? Quant is using powerful computer processing and applying it to fundamental analysis, the same type of a fundamental analysis that comes from analysts from Goldman Sachs, Merrill Lynch, or Morgan Stanley. We're using those basic investment fundamentals, but we're using the power of computer processing to sort that data. So we go through millions and millions of data points, and we refresh it every single day to separate the strong from the weak. And we have an algorithm that we designed at Seeking Alpha, and that algorithm has actually been back tested all the way to 2010. So almost a 14-year period for this back test and showing the trades off of the back test. We do with our algorithm is we take many of those investment metrics, and knowing which ones have the greatest predictive value, we can actually overweight certain metrics. So for growth, for value, for profitability, based on our back tests, we know which metrics have the highest predictive value. And we take a strategy where we apply that investment analysis and we look for stocks that are strong collectively on value, growth, profitability, EPS revisions, and momentum. And we take those investment characteristics, we sort it for each individual stock compared to its sector. And that gives us the ability to determine the strong companies from the weak companies.
And how do you know that quant works?
Well, that is a perfect segue to my next slide, Lisa. So, as I mentioned, we have a back test that goes back all the way to 2010. The back tested results show what the trades would have been applying the strategy. But the great thing is, since we've been doing this so long and we've been active at Seeking Alpha with a platform, after the year 2019, it's actually really simulated trades. So every single day, we know what our ratings are and we know what our strong buy recommendations are. And this portfolio that we've back tested and using the simulated trades, we don't cherry pick. We actually take every strong buy idea we have. So on any given day, it could be about 400 strong buys, and we rebalance this portfolio every day. So if a stock falls out of the strong buy category, it's eliminated from the portfolio. And that's how we measure the performance. And you can see we've had excellent results. As a matter of fact, Lisa, there's been only 1 year out of the 14 where it underperformed the market, and that was last year. And even then, the strong buys on average were up about 20%. So it
Wow.
only slightly underperformed the S&P 500 last year.
Incredible. Great performance.
Thank you so much.
Mhm.
Um, that brings us to our presentation right now. I want to just give a little bit of color on where we are with the economy and the markets. So, as we're well aware, interest rates and inflation have definitely been the foremost concern of the markets for the last couple of years, and that still hasn't changed. Even though we had the Fed take interest rates down in September, we are still seeing some economic data, which leads many economists and market strategists to believe that inflation is a little bit stickier than we expected. And in fact, after the Fed cut rates, we actually saw interest rates start to move up, especially mortgage rates.
Mhm.
We continue to have election uncertainty, and that's plagued the market, for the better part of 2 years. And we're coming into that final stretch right now. As I mentioned, the 50 basis point cut occurred by the Fed. So we went through a long period where rates were moving up over a 2 year period. Finally, we hit a point where there were no more rate hikes. And then in September, the Fed basically said that their inflation that we have seen, it's beginning to be a bit subdued. So they lowered rates. However, that rate cut of 50 basis points recently has been overshadowed, as I mentioned, by rising yields and new inflationary data. The In terms of the labor market, we're at full employment, and full employment is 4.5 to 5%. But we are seeing some signs of nervousness in the labor market. One, there's a Boeing strike that's going on, and Boeing also said they're going to cut about 10% of their workforce. Some of the big IT companies over the last year have also cut their labor forces. We had a major strike on the East Coast that really went all the way from Maine to Louisiana, where the ports had shut down for a brief period. That strike was resolved. Energy has been in a tight range, but it's had fits and starts, and it's shown sort of a lack of demand. And that's why we've seen energy levels pretty low. But occasionally we do see it spike on geopolitical concerns. The technology and consumer discretionary sector, which for years had performed very well, early in the year, it sold off sharply. And we saw the defensive sectors, such as utilities and consumer staples, rally, only to see that come off. And then consumer discretionary and tech rallied strong. And now we're sort of going into a nervous period. So
So,
that's going to take. Go ahead.
Steve, you're the data man, and your second point was market uncertainty with the election. Do your algorithms indicate who's going to win?
Uh, our algorithms do not indicate who's going to win. Then I'm pretty neutral. Hopefully, during this presentation, we're going to make sure we provide an unbiased commentary on the economic agendas of each candidate. However, I don't have to say who's going to win. Certainly, I don't think the polls are going to say who's really going to win either. Um, we saw for the longest period Trump was ahead in the polls, and then we saw that unwind when Biden withdrew, and Harris was the new candidate for the Democrats, and she started to perform well. But in recent days, we actually see and this chart that I'm showing is actually an aggregate from Real Clear Politics. So it's pulling together quite a few different polls and averaging it out. So you can see it's sort of, these we're down to the final stretch, and like each of the candidates, like racehorses, are moving back and forth by a nose at this point. What I will say, being a data person, I don't have a great deal of confidence in the polls based on the last two elections. So you can see on the right hand side, we highlight in 2020, the national polls conducted in the final 2 weeks of the race, they were off by an average of 4.5 points. And in 2016, state level polls in key swing states like Michigan were off by as much as 3.7 points, and nationally by about 3 points. So I don't walk away with a great deal of confidence in these polls. And I do believe in the strength of consensus. And this is like the aggregate poll here, polling all the other polls together and showing what the average is. And it's really almost like a dead heat at this point, according to the polls.
So, Steve, what are your thoughts on a disputed election? Like, how will that impact the market if that happens?
Well, I think a great deal of this year has showed uncertainty in the markets. And that was reflective of sectors like utilities and consumer staples performing well. In recent weeks, I think the market has sort of taken to stride the election, and we did begin to see a rebound in technology stocks and consumer discretionary stocks. So it started, even though we were getting closer to the election, um, investors were returning to fundamentals and weren't being influenced so much by sentiment. However, to answer your question, if we did have a disputed election, of course, that would reintroduce uncertainty into the market. So I think
Mhm.
it'd be quite natural to see the market pull off, and we could see rotation back into the utility stocks and the consumer staple stocks. Um, I would actually look at that environment if it did happen. I would look at some dividend stocks. Chances are some really good companies with great fundamentals that have dividends will probably pull back, and it'll be a great opportunity to get a little bit of extra yield. Of course, I think when the election is resolved, whether we know that on November 6th or 7th or 8th, or if it's like 1 or 2 months after, it will eventually get resolved. And fear and sentiment will not drive the market at that point. Investors always return to fundamentals. So I would
Mhm.
use any weakness as an opportunity to look at stocks with strong fundamentals. But if we have some great companies with strong fundamentals and dividends pull back a little bit, I would use that as an opportunity to acquire some of those stocks.
Great. Thank you.
So that will bring us to our next slide. So, of course, the polls reflect sentiment. Um, Being a quant, I usually look at quant factors, and I find it pretty interesting. There's a professor, his name is Alan Lichtman, and he has a factor model, which is not sort of dissimilar to what we do on a quant side. When we look at value and growth and profitability, we look at those as factors and we score them. Alan Lichtman has about 13 keys that he looks at, and he has determined through these 13 keys over the last 10 elections, he has accurately called 9 out of 10 using these keys when 8 or more are true. The incumbent party wins. So you can see here on this deck, and I would encourage you, you're near a computer, you could Google Alan Lichtman and take a deeper dive into his factors. The factors cover anything from midterm games to no primary contests to the strength of the economy to scandals and military. So he has these 13 characteristics. According to Lichtman right now, he would call it in Harris's camp in terms of these keys. But individuals can take a look at these keys themselves and decide what they think is true or false for these keys. And that's what it comes down to with Lichtman. It's a true or false. It's a pretty, black or white situation according to him. But I'm sure when people look at these individual keys, they might have their own opinions on it.
Wow. So these are 13 binary, true, false, equal weighted factors that determine the winner. That's so
That's correct.
simple. It's so
That
simple, yet so effective.
it really has been effective. I mean, calling the last 9 out of 10, it's been definitely a superior predictor than the polls that we have seen in recent elections. So we'll have to see how he does this year. And again, you may have your own view on these keys,
Mhm.
um, but Lichtman has called it right, and this is what he's looking for. So he does have a good track record for the last 9 out of 10 elections.
Steve, imagine if picking winning stocks was just as straightforward.
9 out of 10 would be incredible. I would probably be retired on a beach somewhere if I could get 9 out of 10 all the time.
So, can you tell me when a candidate ultimately wins, what does that mean for market performance?
All right, Lisa, that is a great question. So I've broken this down to election years and then off election years. So what we're looking at right now is a chart that shows the average S&P 500 seasonality for election years versus off cycles. And it really does indicate that during election years, investors are nervous and they are not investing at quite the same pace as they do in off election years. So performance is still good. You can see on average, using this analysis going back to 1976, that during an election year, the markets were up 7.1% compared to the off cycle where the market was up 10.5%. So I think this speaks to sentiment, you know, overshadowing fundamentals during election years and investors tending to hold back a little bit more than non-election years. The returns are good, in both, But obviously, I think this highlights that people are a little bit more nervous in election years. Uh, but taking it to sort of where the money goes, and we always like to follow the money. If you were to look at money market funds from a period of 1992 to 2023, assessing both equity funds and money market funds, you could actually see the average net flow by year of presidential term. And during the presidential election year, there's a much higher degree of capital flowing into money market funds. As you can see here, it's 195, which would be billion, compared to the equity funds, which is 37 billion. Conversely, when we're outside of those election years, there's a tremendous amount of capital that flows into the equity funds, 202 billion compared to 85 billion for the money market funds. So this is following the money, and I always say follow the money, follow the
Mhm.
data. This definitely shows you during presidential years, the market tends to be nervous, and people basically are guiding their money into money markets away from equities. But when you come out of those election years, the money flows right back into the equity funds and out of the money market funds.
So, what does that mean in terms of timing? Should we be investing now or waiting?
I think this is probably a perfect time. So, the market has hesitated, and what we've seen is that it's definitely been a defensive year. Even though the market is up in excess of 20%, we see defensive sectors such as utilities and consumer staples perform well. And we've seen, a strong flow of money into money markets. We're going to be coming out of that, whether it be a couple days or a month or so. Hopefully, we'll know sooner rather than later, but by all indications, when that passes, stocks do quite well. And I would say if you have your shopping list or companies that look great, have strong fundamentals, this would be the time to be putting them in your portfolio.
Well, you'll probably be helping us out with that today, right?
Yeah, I will. I will. So something else I wanted to show in terms of the data, and remember, this is the data. This is not influenced by myself or Seeking Alpha. I wanted to show what market returns have looked like. So there are a couple different ways that you could look at this. So as I sort of walk you through this one, take it with a grain of salt because there are going to be other slides that I follow up with. But you could see, hypothetically, if you invested $100 in the S&P since 1928, and I actually just put this slide together a couple of days ago. I was really shocked actually by the return that I saw here. During the Democrat years, if you took the total return for each of the parties' period when they were in office, during the Democratic years, the markets on total have been up 800% since 1928 versus the Republican years where it's been up 301%. Now, as I said, you do have to take this with a grain of salt because there are a number of ways that actually sort of equalize this. You can see during the Herbert Hoover years, going into the Great Depression, the market had come down about 69%. So that is absolutely considered an outlier. And then you could take a positive year, where the Democrats were in the office. That's an outlier as well. So if you eliminated the outliers, this is what you would tend to see. So the median performance, um, if we dropped Clinton and Hoover, the market during the Democratic period was up about 48% versus the Republican period where the market was up 53%. So just taking out two candidates over that time frame, you can see the returns are substantially different than in that previous slide. If you didn't take the outliers on and you were just looking at the median performance instead of that total return, you can see it still goes in favor of the Democrats, with the market returning 62% during the Republican period where the market was up about 39%. However, as I said, and we often do this in the quant world, we do remove outliers. It does make a big difference when you take both Clinton and Hoover out of that equation.
So, Steve, this year the market's up about 22% year to date. But based on what you're saying, the markets are typically nervous in election years. So, how do we account for that?
And that is absolutely correct. So, year to date, as you can see, this is sector performance of the markets broken down by kick sectors. And this is really an anomaly. Utilities up 28% year to date. you normally do not see that. Utilities is basically a sector that's always very, very stable, not much of a change in their earnings or revenue streams. So you typically don't see it as the best performing sector. The only time that you really see it as a strong sector is when the market is nervous and there's a lot of fear out there. Uh, Backed up by the communication services sector, up about 25%. And conversely, you could see consumer discretionary towards the bottom, up only 10.8%. Having said that, of course, these are good returns for the markets for any period. But I want to put this in perspective. Those are the year-to-date returns. As I mentioned, more recently, you could see technology stocks have performed well, and consumer discretionary stocks have performed well, where utilities is sort of the middle of the pack. So we've had a bit of a move towards risk on from risk off, which we saw earlier in the year. So investors are beginning to feel more comfortable looking at stocks with strong fundamentals, and the market is not being driven as much by fear. Of course, as we get into the election, there will be a couple more days of uncertainty.
Mhm.
Hopefully, it goes fairly smooth, and we know who the winner is quickly. And I think at that point, investors will feel very comfortable returning to fundamentals, and risk will be back on the table. Interesting enough, though, you can see here, even over the last month, utilities are up about 5.8%. And I will say, outside of being a defensive sector, utilities actually are looked upon a little bit more favorably now for some growth aspects that they haven't had. And that has to do with AI and data centers, which are just rapidly popping up all over the place, and they're consuming a tremendous amount of energy. And utility stocks will actually be a benefactor of this thriving AI and data center market that we're in right now.
So, Steve, what about interest rates and inflation? Do they count for anything?
They do, and I'm really glad that you highlighted that, because that's still one of the foremost economic indicators on people's mind is
Mhm.
both interest rates and inflation. So what this exhibits, we went through a period where rates have been rising for quite a long time. Finally, it stabilized, and we had the first rate cut. So what this chart indicates is typically right when the first rate cut happens, the market actually tends to go down a little bit. And we did see a bit of uncertainty right around the period of the rate cuts. The positive takeaway from this chart, though, is when you do get into period when the Fed is taking rates down, the market tends to do better the month after, the quarter after, the year after. And you can see these are pretty substantial returns that follow that first rate cut. So the Fed, we're not exactly sure how they're going to be assessing the inflationary data that's been coming out. But we believe that the trend will continue to be to ease that monetary policy. And I'm not sure if we'll see rate cuts coming up soon, but that has been basically the speak coming out of the Fed, is that they are looking to take rates down as inflation is more under control now than it has been. And that's a very positive sign for the market. So I would say, based on this sign, in terms of Fed movement, and also based on history showing us what happens after an election year, the market is probably in pretty good shape going forward. So here we go. Coming down to our election, investing for a political strategy, trying to find your idea stocks using precise data driven systems that we have developed at Seeking Alpha. So, regardless of who you are, and at Seeking Alpha, we don't have any preference in who the candidate is. Our preference is to make sure we have a very good data driven system that can help you select stocks. So, according to the Harris Agenda, and the Harris Agenda comes from what has come out of her campaign really over months, but also what she has demonstrated historically. We're able to decipher sectors that could perform well are information technology, alternative energy, and industrials. I would say on the IT side, and there's the exception with Elon Musk and Peter Thiel, who are clearly in the Trump camp, many other tech leaders have displayed that they are in the Harris camp. She's received endorsements from tech industry leaders in California and San Francisco that have deep ties to her personally, and through the industries, very well connected to her. Her Senate record also shows a balanced stance on tech regulation, promoting growth and responsible governance. So we believe that there are a number of technology stocks that could perform well under the Harris administration. Alternative energy, uh, that you have tax credits and energy savings on home improvements like heat pumps and rooftop solar, which she has demonstrated that she is backed. There was the Inflation Reduction Act, which allocates substantial funding for clean energy initiatives. Harris would oversee the implementation of these initiatives. And additionally, she's highlighted the importance of expanding clean energy manufacturing for job growths in that area, such as solar panel and wind turbines. And lastly, in the industrial sector, Harris was supportive of the bipartisan infrastructure law, which was a $30 billion program for the electrical grid infrastructure. The economic plan also emphasizes transitioning to industrial processes for cleaner technologies and domestic manufacturing, focusing on the benefits across various subsectors. So there are a number of industrial stocks and subsectors in industrials that would perform well. Taking it down to stock level, being that we believe her focus would help IT, alternative energy, and industrials, we have selected three stocks. There's Zeta, which is an information technology company. It is application software, and it ranks number one out of 191 stocks in that industry. First Solar, ticker symbol FSLR. Now that's categorized as information technology, but it's really more closely related to solar panels, which sort of puts it in the alternative energy camp. That currently ranks number 9 out of 66. And lastly, PAL Industries, which is electrical components and equipment, that ranks number 1 out of 65. And Lisa, I'm going to give us a little bit more detail on each of these, but I will highlight, I really do believe whether you have Trump or Harris, these stocks have great fundamentals and they're positioned to do quite well, probably either candidate wins. So giving a little color here on Zeta Global Holdings, ticker symbol ZETA. It ranks number 2 out of all our IT stocks and number 1 out of the software. It's AI powered, cloud based, and omni channel marketing platforms go across 15 different verticals. They've had 10 consecutive quarters where revenue growth has been greater than 21%. Their gross margins are in excess of 60%, which is a 21% premium to the sector. And one of my favorite ratios, which is a PEG ratio, it's a combination of PE and growth. It comes in at 1.61 times, which is about a 16% discount to the sector. And in the last 90 days, 8 analysts have revised their estimates up and 0 have revised it down. As you look at the lower left-hand side here, you'll see the momentum grade. And what I really like about the momentum grade is we're looking at the performance of the stock relative to the sector. So it's not just absolute performance. So this really tells us how the company is doing versus the sector. And you can see this is an A plus report card. So we look at 4 different time periods for momentum. We look at the long term and the short term. Long term being categorized by the 1 year performance, short term being categorized by the 3 month performance. And you can see whether you're looking back at that 52-week performance, it's up 233% compared to the sector, up 16%. And in the last 3 months, it's up 48% compared to the sector, which is down about 1%. So it really indicates through its stock price action that the company is doing something right versus its sector.
Steve,
Uh,
can you talk a little bit more about momentum? I mean, it's had quite a run over all of these time periods, pretty phenomenal. But what do you say about the mantra to buy low? Are we waiting for a trough?
I am not waiting for a trough, and I think that would definitely be a mistake, Lisa. A lot of investors, they do wait for stocks to pull back. A lot of investors like purchasing stocks when they're closer to a 52-week low compared to a 52-week high, and that
Mhm.
would be a major mistake. When you look at these stocks, you should be assessing how the stock looks today versus its sector on core investment characteristics, being value, growth, profitability. That's what you should be assessing. If a stock has moved up 200% or 2000% in the last 6 months or year, that shouldn't make a big difference because you want to look at a stock relative to its competition and its sector. And that's what our factor grades do. So if you look on the far right hand side, you'll see the factor grades for valuation, growth, and profitability. That gives you an instant characterization of how the stock compares versus the sector. And we refresh that every day. The importance of the momentum is to give you confirmation that the stock is performing better than its sector. That's why I don't look at absolute value. To
Mhm.
me, I want to make sure I see it versus the sector, and I'm looking for that validation. So it's telling us it's working. At least it's a sort of speak to your question. Um, Empirical data has shown, going back as far as 200 years, that momentum is one of the most important factors. And if you were to take a basket of 10 stocks that were trading near a 52-week low versus a basket of stocks that was trading near a 52-week high, your performance going out 1 year after that point would be far superior if you purchased the basket of stocks at a 52-week high. So I definitely try to uh, tell investors, do not go on that, adage or on that perception. You want to be buying stocks that are at a 52-week low or have come off sharply. Chances are, if that's happened, it's happened for a reason.
Great. Thank you.
So let me take us to our next stock, First Solar, ticker symbol FSLR. As you can see, the factor grade is quite strong for this when you're looking at valuation, growth, and profitability. Again, it gives you that instant characterization of how it is compared to the sector. Some of the big things that we like about this stock is that it's demonstrated 29% revenue growth for its forward estimates. That's at a 367% premium to this sector. So 29% forward revenue growth is just tremendous. If we look historically, year over year, EBITDA growth was 330%. The margins, 43%, are at a 334% premium to the sector. My PEG ratio, it comes in at 0.55. So from a valuation standpoint, if you were to look at that ratio, it shows you that it's at a huge discount to the sector. And if you look at just traditional PE, it comes in at 18.3 times, which puts it at about a 24% to the sector. Um, Taking us to the next stock, PAL Industrials, ticker symbol POWL. You can see it is rated number 3 according to the Quant. Within its industry, it rates number 1. This is a strategic supplier, manufacturer of custom electrical equipment. So it's really in a great place at this time. This stock also is an AlphaPiix stock, and we like it so much that it actually came into the AlphaPiix portfolio twice, 17 months apart. Q3 revenues, which just came out a couple months ago, actually, at this point, it was a 50% increase year over year. The company has a huge backlog. They have a 34% return on equity. That is a return on equity that Goldman Sachs and Morgan Stanley would be very, very jealous of. And they beat estimates in their last quarter by $1.63 in Q2. When you look at the factor grades on the right hand side, valuation you can see is a little bit rich, but it's got almost a straight A report card for all the other factor grades: growth, profitability, momentum, and revisions. And again, those factor grades are all sector relative. So this gives you an instant characterization how Powell compares to the rest of the sector.
Steve, before you move on, if you
Sure.
just go back to that previous chart, I'm somewhat new to Seeking Alpha, and I find this quant rating history chart really fascinating. I mean, here you could see the ratings oscillate between hold and strong buy, and the really impressive corresponding performance just gives a lot of clarity and transparency as to what we thought things were and where we think things are now based on the algorithms in your quant model. So I just wanted to point that out. I think it's a very cool feature in premium.
At least I really appreciate it. I think, early on we showed the performance of all the strong buys. We try to be really transparent, and we are, because you could dig into it on a stock level. So on every single stock on the Seeking Alpha premium platform, you can go to a section called ratings for every stock, and it will show you the history on a 3-year basis, 1 year, 6 month, 1 month, what our grades were
Mhm.
during those specific days, as well as the overall directional recommendation. And you can see, going back 1 year ago, Powell was a lot less than it was now. The stock has really appreciated. So we've had a strong buy at the right places. System very transparent. And even when it does change, you can see we went to hold, and the stock actually came off during that period a little bit. But then it looked good again. The factor grades changed in favor of a strong buy directional recommendation. And it was really good timing. It picked back up and bringing us to where we are now. The stock has been a great performer. but very transparent.
Very cool.
So this brings us to the Trump agenda. So obviously, Trump was already president, so we know what he likes, and we know what he's been talking about in the campaign. So there are three sectors that we highlight based on the Trump agenda. That would be aerospace and defense, financials, and construction and engineering. And again, I will mention these are sectors that we're highlighting based on him winning. But what we'll find, I think, with the individual stocks is they all have strong fundamentals. So regardless of Trump or Harris winning, I think these stocks will do well. So I'm going to take us directly to those stocks. Aerospace and defense, financials, construction, engineering. For aerospace and defense, we have Northrop Grumman, ticker symbol NOC. This is in the industrial sector. It ranks 22 out of 626 stocks, but within aerospace and defense, it currently ranks number 2 out of 59. So it's a really lofty ranking. You can see the factor grades underneath, valuation a little bit rich, but all the other grades for growth, profitability, EPS revisions, deep in the green. Uh, then we have First Citizens Financial. That is a diversified bank in its industry, and it ranks number 6 out of 67. Again, the valuation coming at C minus, a tad rich on the valuation, but all the other grades looking fantastic for this core investment characteristics. And then we have AGX, an industrial, a company that I really like a lot. Currently ranks number 4 out of 626, but within construction and engineering, it ranks as our number 1 stock with great grades. Again, valuation being a tad rich, but highly doable. So I'm going to take us into a deeper dive. Here's Northrop Grumman. Um, I cannot believe the backlog that this company has. They have an $83 billion backlog. That is larger than some companies in the S&P 500 in terms of their revenues. So this is just absolutely an immense backlog that they have. And you can see by the factor grades on the far right side, growth is very strong versus the sector, profitability very strong versus the sector. Analyst revisions continue to move up. So that's actually how the number of analysts that move their earnings estimates up relative to the sector. The forward long-term earnings growth rate is projected at 29%, which is a 158% premium to the sector. Return on equity for Northrop Grumman is 15%. The PEG ratio comes in at 0.72, which on a valuation standpoint, it puts it at a 62% discount to the sector. So again, I really like that because that metric combines both PE and growth together. In the last 90 days, 22 analysts have revised their estimates up for Northrop Grumman. So analysts continue really to like this company, and they're putting their vote out there by moving their earnings estimates up. Next stock is First Citizens Bank Shares, ticker symbol FCNCA. Currently ranks number 6 out of diversified banks. It's a good sized institution. They have about 500 branches throughout 23 states. They acquired Silicon Valley Bank back in March of 23, which I just think was an excellent purchase for them. Will really sort of take up their involvement in private equity and technology in California. So it was just a great acquisition for them. The annualized loan growth has been coming in at 11.8% and deposit growth at about 4%. The revenue growth is 29%, and that is about a 427% premium to the sector. ROE coming in about 13%, and the multiple is really cheap, coming in at 9.7 times.
Hey, Steve,
So,
before you move on, I'm sorry.
yeah,
Can you speak a little bit more about the factor grades? So are you looking at a handful of binary, like good or bad factor grades like the Lickman model, or are you looking at hundreds of metrics relative to the sector?
this is a lot more metrics than the Lichtman.
Well, not
uh,
13, right?
yeah, so for each of these the factor grades, valuation, growth, profitability. There are dozens of metrics that we look at. So when you're on the Seeking Alpha Premium site, it's actually really very transparent. When you go to the stock page, you'll actually just be able to click on valuation, growth, or profitability, and you'll see all the underlying metrics that we use that help us come up with that overall value grade. And that basically helps us determine what the directional recommendation is. So there are many, many metrics that we're looking at.
So you're starting at the top of the pyramid, you have your quant rating. You could dive in further, look at the factor grades, and then if you want even more clarification, you dive in to each of those grades to get all of the underlying data. Is that
That's
right?
correct. Again, a very transparent system. When you get to that stock page, you'll see, just as you see here, the factor grades, but you're literally just one click away from seeing all the underlying metrics.
It's great.
So that takes us to our next slide. Argon, ticker symbol AGX, currently ranks number 4 out of industrials, and it's number 1 in terms of construction and engineering. The stock has really been on quite a tear lately. It's looked great. You can see the factor grades, valuation coming in at D plus, but growth compared to the sector B minus. One of the things that I want to highlight here is the trend that I'm seeing for the company now versus where it was 6 months ago. So, as I mentioned, with these factor grades, it's sector relative. So, it gives you that instant characterization of how the company compares to the other construction and engineering stocks. But what we also do is we show you what the trend has been. So, you could see 6 months ago, the growth grade for this stock was actually a D plus. Then 3 months ago, it moved to a C plus, and now it's moved to B minus. So, you can see the growth is really moving in favor of this company compared to the sector for where it was 6 months ago compared to where it is now. So this gives you the ability to look at companies not only relative to its sector, but also relative to its history as well. So I really like the trend that we're seeing there. Now, compared to the sector, if you look at the momentum grades on the lower left-hand side, this is an A plus report card. So whether we're looking at the last year or the last 3 months, you can see the stock is crushing it compared to the rest of the sector. The 1 year price performance, you can see for the stock is up 176% compared to the sector up only 22%. So again, I've mentioned, like, don't be scared by this performance, because when you're looking at a company, you're looking at its investment characteristics relative to the sector. So what these momentum grades are just telling us is that the company is crushing it compared to the rest of the sector. But when we actually look at the factor grades for value, growth, and profitability, it still looks really good compared to the rest of the sector. So that's what you want to be highlighting when you're conducting your investment research. And of course, when we look at some of the data points here, they have a $1 billion backlog. Year over year revenue growth was at 48%, levered free cash flow margin at 21%, and the price to cash flow was 8.71 times. So, from a valuation standpoint, that puts it at a 40% discount to the sector. So I think that sort of takes us where we are through our screens that we utilize, looking at those sectors and helping us to identify stocks within those sectors. So some people, Lisa, might think that's a lot of work, and they just want to have the best ideas handed to them.
That's right.
So about 2.5 years ago, I created a product called AlphaPiix. So for people who really, they want research that's been vetted, but they, want some of the best ideas brought forward to them, that's what we do with AlphaPiix. So every month, twice a month, we send out our top strong buy recommendations. We've been doing it for 2.5 years, and you can see the performance has been really exceptional. Since inception, which you can see here on the bottom, AlphaPiix is up 150% compared to the S&P, which is up 53%. But again, being very transparent, I want to show you where we've been for the year to date. So on the far right-hand side, you can see year to date, the AlphaPiix portfolio is up 47% versus the S&P up 22%. Over the last 3 months, AlphaPiix has really done well. The portfolio is up about 12% versus the S&P up about 6%. And over the last month, AlphaPiix is up almost 4% versus the S&P, which is up about 1.64%. So again, if you don't want to go through the screeners and you don't want to say, okay, these are the sectors that are going to do well. Sorry, of course, my doorbell's going off. um, you can see that the performance has been doing quite well over a long period of time for 2.5 years. If you're interested in the AlphaPiix product, you can see we have the QR code here. You could simply just bring that up, and it will give you more information on AlphaPiix, provided you don't want to do a lot of the research on your own, or you just like the concept of having the best ideas brought to you.
So
Um,
one thing I just want to note
sure.
for our investing community is, so you are given these two stock picks over an email, but then you do a deep dive with your community, right? You go and do a webinar for each of these stock picks twice a month where you explain why, right?
That is absolutely correct. So, following up with that transparency, we send out an article via email. It also goes on the platform, so that happens twice a month. And as a matter of fact, we actually have a weekly for AlphaPiix, which sort of just goes over what's happening with the economy and the market on a week-to-week basis. When we do have each pick go out, in addition to the article, there is also a webinar, and on a quarterly basis, we also have a webinar. So we just, we're really out there providing a lot of information about the individual picks and the overall market to keep people, really sort of familiar with what's going on with the portfolio, but overall with the state of, the financial markets. A little bit about AlphaPix here too. As I mentioned, we send you 2 emails a month with those picks. Of course, if a stock were to go to a sell, you would get an email whenever that happens. For AlphaPix, we do have a couple additional parameters and criteria that go above and beyond just the strong buys that we have for the Seeking Alpha Quant system. We do look for companies that have a market cap is in excess of 500 million. We're also looking for a daily volume to be greater than $10 million. So we want some liquidity. We invest in all sectors with the exception of REITs. REITs are a bit of a different breed. So AlphaPix will look at all sectors X REITs. Um, and it's also designed for long-term investors. We're not looking to move people in and out of stocks frequently. So if a stock is in the portfolio as a strong buy or a buy, and its rating drops down to a hold, we'll actually keep it in the portfolio for about 180 days because we often find that companies could be doing quite well, and sometimes that hold recommendation will kick in because the stock becomes slightly overvalued. Often analysts will take their growth estimates up, and those valuation metrics will sort of readjust, and the stock can go back to strong buy. However, what we found through our back testing is if a stock is a hold for a solid 180 days, at that point, it's good to remove it from the portfolio. And just also sort of sharing in terms of performance, a lot of people are always focused on the Magnificent Seven. So I
Mhm.
wanted to highlight the year-to-date returns. Um, we have AlphaPix is the sort of teal blue line on top. You can see as of this date for October 23rd, the AlphaPix portfolio was up 45% compared to the Magnificent Seven, which was up 39% for the same period. Both are really crushing the S&P 500, which was up at that point about 23%. The S&P 500 it is market cap weighted, so it does favor the Mag 7 stocks. If you are actually to take out the Mag 7 from the S&P 500, we call it the S&P 493, you could see the S&P would have only been up 17.7%, so significantly lower than the 23.4%. And then if you were actually to look at the S&P on an equal weighted basis, it's up only about 14.5% year to date. But AlphaPix clearly at the top there, coming in with a return of about 45%, outperforming the Mag 7 and the S&P 500.
You're
And
really serving
Lisa,
up the best stocks on a silver platter. So bravo to your performance. It's
thank you so
incredible.
much. I appreciate it. So Lisa, I think that really brings us close to the end here, right?
That's right. Yeah. Thank you so much, Steve. I think we all learned quite a bit today, but that is all the time we have.
Lisa, I
If
will
you,
just say though,
yeah,
we are going to take a little bit of a deeper dive. If you were interested in what we presented on, I'd say save the date, Monday, November 4th at 4 p.m. I will be doing a webinar. It will be on the same theme for Trump versus Harris, the impact on portfolios, but we're going to take a much deeper dive during that period where we'll actually be going into the Seeking Alpha platform and we'll be showing you the screeners that we use. We'll be assessing the stocks at that time and that date right on the platform. So a little bit more of a deeper dive. So, Lisa, I just wanted to throw that out there if people are interested in this.
absolutely mark your calendars. So thank you so much, Steve. Appreciate all of your time and your insight. Super helpful.